The recent reports about an acceleration of coronavirus cases has hit some markets and some markets very hard. Chinese car production, for example, in January was down 20% year over year, and big global manufacturers, not just in the auto sector, that rely on Chinese-made parts are beginning to have to find ways of replacing those parts or moving production lines into areas that are not so badly affected. Joining us now to discuss how all this is affecting the mining sector as a base resource for many manufacturers is John Mayer from SP Angel, who's just returned from the mining in Durban, the world's largest annual mining event, which is held in Cape Town. John, welcome. First, in Cape Town, was there much chat about coronavirus and how it's affecting the mining sector?
Well, we were talking about it, but the mining companies seem to be looking through that. They're dismissing it, as far from what I can see, as an event that isn't yet affecting them. I think it will affect them. But it does feel that the industry, we're an industry that's very good at reacting to health scares. With Ebola, the mining companies were brilliant at making sure their staff were well protected, at monitoring, and actually doing really good things in the local communities. So they're fantastic at all that, even though they're mining people rather than healthcare people. But at the same time, they're saying, well, this isn't with us yet, so we're thinking about it, but we're not doing anything yet.
Yeah, so far as we know, I think latest figures suggest something like 60,000 people infected. Overnight we had some 247 deaths. I think there's now more than 1,300 people that have died attributed directly to coronavirus. What is the mining sector's likely reaction to all this? I mean, what is it that we should be watching for in terms of news headlines? I talked a little bit about the manufacturing side of things, but what about mining?
Well, we have a team of healthcare analysts at SP Angel, and we do a lot of healthcare business. They're very cautious about what they say, so we, in the mining team, extract and extrapolate from what they tell us in the office. It is going to have dramatic impact on supply chains. We're already seeing it. Now, the impact of that impact on the supply chains on the mining sector is going to be very interesting. So China is a huge producer, or a huge converter of metals. So they do an awful lot of copper smelting, for example. That copper smelting has seen some disruption. It was seeing a bit of disruption anyway from environmental regulation in China, a lack of acid for producing copper metal, for example. And so we were seeing a bit of a shortage, and we know that a lot of copper has been going out of warehouses anyway. Now, if you're an American manufacturer, let's say of copper tubes, and the copper's not arriving on a boat from China because everything's been held up. Containers are being held up for decontamination. People are not necessarily able to go to work in China. We know they've got a problem with truck drivers, and the steel producers have asked the government to help them with truck drivers, because these guys are in lockdown in Wuhan and other cities. They can't get through. There's roadblocks, government roadblocks. There's all sorts of things disrupting the entire supply chain. So you're in America saying, where are my copper tubes? You're going to have to buy those tubes from somebody. So you go locally, and the local guys say, okay, we'll ramp up production. We're going to have to get our raw copper from somewhere. So they go to the COMEX warehouse and buy that copper. So it's quite probable that the price locally in America will go up a lot, whilst the price in China may even go down. So I think we're going to see this huge divergence. And of course, guess who's going to make money out of that? It's going to be the traders, and the biggest trader in the world is Glencore.
Let's just stay on the copper price. We've got it up here on the chart at the moment. You say these two divergences in terms of directional price movements depending on where you are in the world. What's the net effect then of the copper prices we have at the moment, what, 57.42 at the moment?
The net impact is likely to be negative. Any disruption to a supply chain will cause problems for manufacturers. Manufacturing will then slow. First they'll use up any stocks that they've got. But we live in a world of just-in-time inventory. Yeah. The steel producers in China said they only had 5 days worth of raw materials. So that's why they're asking the government to step in and help, as in get the truck drivers back into their trucks, get the trains moving on the railways again. We are expecting that stockpiles in ports will start to rise, and then at that point, when those stockpiles have got to a certain point, they'll say, well, no more ships, please. Yeah. There may be even ships that get returned to Australia.
Still full.
Still full, yeah. or they'll get diverted somewhere else. Right. And to be honest, they'll go to India, they'll go somewhere else. So the traders will divert these things. So they shouldn't be going back. That, I mean, worst case scenario is they go back to Australia. But it will back up the supply chain. It will slow sales. Now, it may be if the Chinese contain the virus, and they're working really hard to do it, if they contain it well, then everything springs back to life relatively quickly. But my personal view is the stock market has rebounded and recovered much faster than it should do.
Prematurely?
Yes, definitely.
Yeah.
Definitely. We are still seeing cases pop up around the world. I know at the moment it's all very containable, but this is a really infectious virus. This isn't a little bit infectious, this is really infectious. And the BBC did a wonderful case on the 1918
the Spanish
flu, yes. Well worth watching that, and quite reassuring actually, in that in this day and age we can manage things much, much better than they did back then. So I think that, we shouldn't be panicking, but I think we should be pretty careful about this, and we are going to get more disruption. I mean, consumer confidence has been hammered. So this thing about the Chinese buying less cars, well, of course, consumers are going to buy a lot less of everything. I think there'll be a certain amount of stocking up and hoarding around, not just China, but elsewhere in the world, where people are more careful about what they do. And so certain prices, so there'll be a bit of inflation coming out of this in certain areas.
Yeah. Just want to turn to the point you mentioned about the traders, the metals traders. We've got a chart here for Glencore. We can see that since the beginning of 2018, when we were 417 on the London Stock Exchange, here we are now at 234. Presumably, as you say, Glencore could potentially be a really big beneficiary.
I think so. I mean, the traders are incredibly important to us. When boats start being diverted and supply chains have problems, it's the traders that are the guys that get you out of trouble. But of course, there's a cost to that, and they'll say, okay, well, if you want more copper in Chicago or somewhere on the Rust Belt,
it's going to cost you.
It's going to cost a bit more, because lots of people are going to be suddenly looking for that copper. So I think the big beneficiaries are going to be local manufacturers in the US, the UK, and Europe. But the disruption will cause delays. And let's say you're producing air conditioning units and you need lots of copper. You're going to want to put more silver in them because it's antiviral and antibacterial. So there's going to be lots of that. I mean, handrails should be made out of copper because of its antiviral properties. And so, yes, and at the end of the day, the Chinese are going to say they want to keep their economy going at whatever pace they want it to go at, normally 6%. So they will ramp up infrastructure spending. We've already seen a certain amount of that. They've already injected liquidity into the Chinese economy. Hundreds of companies are said to be looking for state-backed loans out of the banking system. The Chinese banking system is going to have a horrendous time sorting all this out, but there'll be opportunity there as well for them. And but at the end of the, so it may be that when they start building all this new infrastructure in order to get the economy going again, that they buy a lot more metal, and that will be copper, steel, concrete, all these things.
Yeah. All the base materials. Let's talk about what I like to call these sort of new tech metals, if you like, the rare earths, because China, my understanding is they produce something like 120 million, I think, metric tons of ore a year or whatever it is. So the next nearest producer is Australia. What's this mean then for, as I say, new tech, especially electric vehicles? If we do see a continued disruption in China and there is an acceleration of the issues that we've just highlighted about the tragedy surrounding the human side of this, but on the mining side, if you start to see these big mining production units stop in China, what then happens to these rare earth hungry industries, electric vehicles?
Well, there is rare earths, raw feedstock or rare earth ore available in the rest of the world. You've got a whole bunch of companies listed in the UK: Macango, Rainbow Rare Earths, Pensana. That's just three of them. There's not much refining capacity outside China. There's a bit in Thailand, Vietnam, I think. There's a bit that can be reactivated in the United States, but almost all of it's in China. And more importantly, the permanent magnets are almost all exclusively made in China. So that's where they put the neodymium, the praseodymium, the dysprosium, maybe one or two other metals in the mix, into the magnets. And those magnets are crucial for wind farms, for electric vehicles. Now, Tesla started producing cars without permanent magnets. They very quickly realized that the car goes faster and better and further if it's got permanent magnets in there. I mean, they could switch back to non-permanent magnet motors, but I don't think they'd want to in a hurry. So they've got to stimulate other people to start putting these raw materials into their magnets. And at the same time, the coronavirus produces an amazingly good excuse for the Chinese to restrict to supply to companies outside China. So there is this sort of, they can play some games while they're at it, shall we say?
Yeah. Let's pick up on the flip side of this. You mentioned this in your morning report, I think, more than one occasion recently, about the security of the safe haven end of the metals market, the gold producers and so forth. Is this a really easy play on an upward move on the gold market? Do you think this disruption we're seeing in the economies because of what's happening with coronavirus?
Difficult to absolutely know. As you mentioned earlier, the consumer demand for jewellery may fall off, but at the same time, if one starts to think about more high-risk cases, if the coronavirus is not contained, if it spreads around the world, if cash money becomes less important, gold becomes more important. That's physical gold. And we would expect to see the gold price rise in this environment and well, shall we say, outperform other financial instruments, which is what it does. I mean, gold has done that for thousands of years. It's what it does best.
I want to steer the conversation back to an area we discussed before, and that is the metals that are associated with vehicles, palladium and platinum particularly. If we could bring up a chart of palladium, we can see clearly that we've seen these record highs recently, and it looks like this now wants to return to those recent highs. Are you backing this sort of move? Is this a logical move, bearing in mind what's happening with vehicle production at the moment and where it's used within the vehicle space?
Well, palladium is really important for gasoline or petrol vehicles, whereas platinum there's more platinum in diesels. So people are buying less diesels, people are buying more petrol and gasoline, and so the demand for palladium has gone up. And also the car companies dare not thrift anymore on palladium. They cannot afford to get hit by the regulators again. They really need to meet their emission standards. So each car uses 1, 2, 3 grams of palladium within its catalyst. It's a tiny amount. It may be $150, for example, of metal, but it's essential for selling that car. So the price goes up. Things like Toyota Priuses, which are often hybrids, they tend to use a bit more in the catalyst because that catalyst is often running slightly cold. It's a lot of stop-start type work on the motor there. So they're a bit more heavy on their loading, for example, according to the size of the engine. It just means that there's more demand than there probably is supply, and the price has to go up.
Yeah, and going on to the platinum chart, you less confident about platinum? Are you in telling clients that maybe this is not necessarily the area to be in?
Well, the mines that produce palladium also produce platinum generally. The two come together. The price mix is important for keeping those mines going and for encouraging new mines to open up. It just so happens that in South Africa, mines have been closing. Stillwater, which is a great company in my view, and I've sat down with the chief executive a few times over the years. They very bravely bought Lonmin. The first thing they did was they went in and they rationalised and they cut shafts and they cut production. They'll be able to reopen some of that hopefully, but the net effect was to restrict supply from the market, and hence the price carried on going up.
Yeah. Okay, all right, John, thanks indeed for passing by. It's good to catch up with you again about the mining sector and more specifically with the disturbance that's going on within the sector because of the coronavirus. That's John Mayer, mining analyst and partner at SP Angel.